Hey friends, Lucian here with the Bullish Bears team. This video is going to be about the intrinsic value of an options contract. So intrinsic value is the in-the-money portion of an options contract. Now this is going to be specifically regarding being an options buyer. It's different for being an options seller. If you need to know or you want to know more about options selling, make sure you take our advanced options course. So this video is going to be specifically on buying calls and buying puts. So intrinsic value is the difference between the strike price of an options contract and also the current price of the stock. So again, it's the difference between the current price of the stock and the options strike that you purchase. So let's take a look at several real-world examples and how you calculate the intrinsic value of a stock. So this is all done through your platform that you use. Again, this is TD Ameritrade's platform, but whatever platform you use, it's done automatically when you go to place the order. But I want to show you kind of how to figure it out yourself so you understand, when you're looking at the order entry, you know kind of how to do it yourself before it does it automatically, so you get an idea of it. So if you look at this picture here, you'll see at the top left, Apple. That is the current price of the stock when I took this snapshot. Now, when you look at the chart, you'll see black shaded areas and purple shaded areas. The purple shaded areas are the in the money portion of the call side on the left and the in the money portion of the put side on the right. And the black shaded areas are the out of the money portion, right? So there's in the money and out of the money. So this video, we're going to specifically look at the in the money portion of both calls and puts. So let's look at the call side on the left first. And all you need to do to figure out the difference or to find out the intrinsic value is take the current price of the stock of Apple, so 117.34, and then we'll just look at the strike price of $110. So you just minus $110, and that would be your intrinsic value, $7.34. If we look at the next example of $114, you just take 117 times or .34 minus 114, and that's $3.34. 117.34 minus 117 equals 34 cents. So you'll see the deeper in the money that you go, the more intrinsic value that you get. And that's why the price of the options contracts increase. You pay more because the likelihood of your options contract expiring in the money is much higher. So you pay more for your options contract because your likelihood or the likelihood of that contract as an options buyer expiring in the money is much higher. The closer you get to in the money, the lower pricing goes. And then when you start to go out of the money, you'll see it's a lot cheaper. So you'll see, 117.34. Now this is, again, out of the money. We're going to just pay attention to in the money over here. So it's these, on the left side, this is the call side. When we flip it, let's look at some put areas down here. If you're looking at in the money puts and how that breaks down, you'll see 125, or so 125 minus 117.34 equals $7.66. So you're seeing you're buying puts, so you're putting it to somebody else at a higher price. So when you're buying calls, you want the price to go up. So you're buying strikes. If you're looking at in the money portion, right? These prices are higher because you're buying, you can exercise, if you decided to exercise your options contract, you can purchase, let's say Apple, at a lower price before, an expiration date in the future, right? So you're buying, if you're an options buyer, you want to buy low, right? So these strike prices are below the current price of Apple. when you're buying a put, again, you can do a couple things. You can buy with options contracts. You can just buy and sell the options contract itself, or you can exercise your options contract and own physical shares of the company. Again, typically most options traders are just buying and selling the options contract itself, unless you have like a bigger, you have tens of thousands of dollars in your brokerage account. So if you don't and you have a smaller account or $10,000, $20,000 or less, typically you're just going to buy and sell the options contract. But again, as your account grows and you get more down the road, you may decide to exercise the options contract and own physical shares of Apple or whatever company it is. So looking again on the put side, this is where you would put Apple at a higher price, because remember, calls you want the price to go up, puts you want the price to go down. So if Apple falls in price, this would be a strike price of $125 minus the 117.34. So you're putting it to somebody at a higher price. So the intrinsic value of that options contract would be $7.66. If you take the 120, again, just 120 minus 117.34 equals $2.66. And then you'll see it's going out of the money in the black area on the put side now. So that's how you calculate, again, the intrinsic value. It's just the current price of the stock minus the strike price, and that's how you figure it out, and that's how you come up with the actual intrinsic value. So this is showing you right here an options chain with 4 days until expiration. Let's go out and look, about 25 days out and just show you, how this all comes together when you're actually going to place an options, a real options trade. So typically, again, that was, the previous slide was, short-term trading. So if you're looking to day trade or do a very short-term swing trade, if you're looking to go a little bit further out with options, this is an options chain that has 25 days until expiration. So if you look here again, the intrinsic value is still the 117.38, on the call side, minus the strike prices that you see over here. But just to kind of give you an example of how this works before showing you, I'll show you how it works automated in the system. I just want you to see how you kind of calculate this on your own and then show you how it just breaks down easily when you go to place your order. You'll see right over here next to $110, you'll see the price of, if you purchase the ask, it would be $875 for the one options contract. And how you figure that out, again, is every options contract is worth 100 shares. So it would be 875 times 100, and that's how you get $875. So in order for you to break even on this trade, if you purchase that $110 strike, you would take the $8.75, add it to your strike price of $110. That would be a total of $118.75. So basically, by this expiration date, 25 days out of December, I'm making this video December 18th, 2020, Apple needs to be at $118.75 to break even. The higher that Apple goes, the more in the money that your option contract gets. So let's say, it goes up to $120, then, now you're break even. Now you have $1.25 in intrinsic value, right? So again, real world examples, you want to know what you're actually paying for the price of the options contract. So this is how you figure out what you're actually paying. This is how you get your break even. And the more it gets above this, the more intrinsic value that your options contract gets. So let's do that again. Let's look at $114 right down here. You'll see there's a price of $5.75. So you add 5.75 on top of $114. So that means by expiration, Apple needs to be at $119.75 or higher to break even. So you'll see Again, it's getting a little bit lower in price the more you go towards the in the money areas because your odds decrease of it expiring in the money. So this probability of in the money, again, shows your probabilities of that options contract expiring in the money. This is on the call side, and then you can just flip it over on the put side over here, and you'll see your probabilities over here on the put side. Let's take a look at a couple of put examples to show you. So how you calculate it on the put side instead of adding it onto the price of the strike price, what you pay over here on the ask, you would, again, by the way, don't just go and buy the ask. You want to make sure you get the best, pricing. Again, the higher the better or more reliable the price of the stock is, the better the bid-ask spread is. So when you're trading highly liquid stocks, you can get them tighter and get, better fills. The less reputable companies have a wider strike price, and it might be harder to get your fills, as well as how much liquidity there is, how much open interest. Again, you have to look at those factors as well. Our courses, again, break down in both of our options course all the different moving parts of options to help you kind of break this down. But I don't want to put too much in this video. I wanted to specifically talk about intrinsic value. So how you figure that out over here on the put side is take $125 minus $8.50. So 125 minus 850 is $116.50. So you'll see, again, you're paying higher for this price over here because, the Apple only needs to fall about a dollar by expiration. So it's more likely, the reason why the odds are high over here is because there's a good chance that Apple will fall a dollar by expiration. When you go down further, let's take this $120, 120 strike, 120 minus, what is that, 495? That means Apple would need to fall to $115. So that's about $2.50, right? So you'll see, again, the closer in the money, the less you pay because the likelihood of it expiring in the money goes down. So this probability of in the money, column that you add on to your charts is very helpful kind of to give you a bird's eye view when you're going to place a trade, your likelihood of success. Don't just buy an options contract just because the likelihood is high. You obviously want to know your technical analysis and get your patterns and stuff to get the proper entries, because otherwise you can get in at a bad entry and then you could be stuck in it for a while. And on the opposite side of intrinsic value is extrinsic value, or time decay. So options are decaying assets. So every day that the options contract works against you, so if you're bullish and you buy calls on the stock and the price starts going down, you start losing extrinsic value or time value, and that's what eats away your options contract. And that's why they say options are risky, because you obviously, with buying naked calls and puts, you need the direction to go, you need the stock to go in your direction as quickly as possible. If it goes the other side, that's when you lose extrinsic value, and that's time decay, and that's what eats away your options contract as an options buyer. Time works against you as an options buyer. It doesn't mean you don't buy options contracts and don't be a buyer. Again, you have to understand the differences of both, and we explain options selling in our other options course. But again, that's where kind of give you a little taste of what extrinsic value is. There are several different moving components to options contracts, but again, intrinsic value is the in the money portion. So that's where, again, this column kind of shows you, it's a handy column of your likelihood of it expiring in the money. But just kind of minus, take the strike price minus, or the price of the current stock minus the strike price, and that's how you find intrinsic value. So if you want to see how this is all calculated real world, it's just very simple over here. Here's the Thinkorswim platform. Most platforms are very similar in their order entries, and it breaks it down. So if you look over here on the call side, if I was to buy, this is real market hours right over here. If I was to buy, just kind of go over here and buy just a single options contract. If I go and place this order, this is the 110 strike. You'll see right over here, the price that I would pay for that is $810 if I bought the ask. And you'll see the break even is $118.10. So that's the reason why is I paid $8.10. So I just add that $8.10 on top of the strike price of $110, and that's where I get $118.10. So this is where, again, it shows you your break even. So, the more that price gets above, if it goes up to 120, then I take $120 minus 118.10, and that would be my intrinsic value. Let's take a look at a couple more examples. Let's say we look at $114. So let's just say I bought the ask over here, right here. You'll see here my break even would be $119.10, and that's because I just take the $5.10 right here and add it on to my $114 strike price, and that's how I get the break even of $119.10. So let's look at the flip side. Oops, don't want to confirm that order. Let's look at the flip side over here and go to the put side, right? So let's go over and we'll buy a put right here. So you'll see when I go to place this order here, it is $940 for this call. Again, because I'm buying it at $9.40, which you'll see right here. And we take 125 minus 940. So again, on the put side, you're subtracting it because you want price to fall. So it's 125 minus $9.40. And that's how you get the break even of 115.60. So if price falls down to, let's say, 114, and keeps falling, then you'd have 115.60 minus 114. So let's say, what is that, $1.60 of intrinsic value. So that's how it calculates in the real world when you put it all together. I'll do one more example because, again, repetition is key. Let's go over here, let's say to the 120 strike. When you go to place the order right over here, right here, you'll see 565 because, again, that's what I paid, 565 bucks, so $5.60 times 100, which is $565, and you just take the 120 minus the $5.65, so my break even would be 114.35. So this is kind of how, again, I made it a little bit more in depth because I wanted to kind of break it down and then show you some real world examples of how it kind of comes into play. Again, your broker will calculate your break even, strike prices, and everything for you. But kind of understanding how the concept works. As an options buyer, when you're buying calls and buying puts, you want that contract to expire in the money. The more in the money it expires, the more intrinsic value that it has. The more, again, if you're an options buyer, if it goes the opposite direction of, again, if you're buying a call and you want the price to go up, if price starts falling, you start losing lots of extrinsic value, which is time decay, and that's what eats at your options contract. And that's why they say options are risky. Again, that's why you do not want to just buy any type of options or just stock in general if you don't understand proper technical analysis and when to get in and get out. And that's where, knowing candlesticks and patterns and, how they all come together, that's what helps you get a trader's edge on when to enter and exit a position. So hopefully this video on intrinsic value helped you, and we will see you in our community. Enjoy.